there's a power company quietly fueling the future of AI, data centers, and the clean energy revolution, and institutional analysts love this company, with 14 out of 15 buy recommendations. With massive investments in battery storage and renewable energy and nuclear energy, is Vistra the hottest energy stock? Today, we're breaking down Vistra's business and its stock potential in this booming energy market. As of February 7th, 2025, Vistra is trading at $167 a share with a 52-week high of $175. Its market cap is $56.8 billion, which is roughly 2/3 of Constellation Energy's market cap of $96.9 billion. Vistra has been public since 2016, but it's only been since 2023 that their stock grew over 650%, while Constellation grew 550%, and S&P 500 grew 30%. Vistra's top competitor is Constellation Energy. These two are the only large-cap publicly traded companies with power generation, not utility companies, and both have nuclear energy in their portfolio. Vistra's nuclear currently makes up 15% out of their energy portfolio, and 80% is from gas and coal, but they're planning to retire some of their gas and coal power generation and expand their nuclear. Comparatively, Constellation's power generation from nuclear is currently 88% of their portfolio, and after the Calpine acquisition is completed in Q4 2025, they expect their portfolio to generate 56% from nuclear. Vistra has the second largest nuclear generation in the US after Constellation Energy. They completed the acquisition of Energy Harbor's 100% nuclear power plants in March 2024. Vistra's business segment for clean energy is branded Vistra Zero, which contains solar, nuclear, and energy storage. Their Vistra Zero business segment generates 7,800 megawatts of zero-carbon power. That's about 25% of clean energy that Constellation produces, which is about 32,000 megawatts. Vistra has robust revenue streams. Their revenue has grown on average 12% year over year for the last 3 years, and their revenue in FY24 is expected to have a 15% growth year over year, coming in at $17 billion. That shows really strong growth rate for an energy company, which typically shows stable and modest growth of 3 to 5% year over year. Vistra's trailing revenue multiple is 4.5 times, which is in a similar range as Constellation Energy's. The forward 2026 revenue multiple is 3.6. This downward EV to revenue multiple suggests that the company is expected to grow, and this might not be reflected in the valuation yet. But like Constellation, Vistra is not being valued as a traditional utility company, but rather a growth stock in the energy space. Since the Energy Harbor acquisition of the nuclear fleet was completed less than a year ago in March, the market may also be waiting to see more synergy in the full first year before reflecting the future growth expectations into the valuation. Vistra has been profitable since 2023. Their EPS in FY23 was $3.60 and is forecasted to be $5.80 in FY24, a huge growth. Their EPS is forecasted to grow further in FY25 and FY26 to $8.70. As an established power generator, they've paid off their initial high fixed cost. Management guidance for EPS in FY24, based on 340 million shares outstanding as of September 30th, 2024, is between $8 and $8.50, which is higher than analyst consensus. FY25 is a bit more subdued than analyst consensus, with an EPS between $6.80 and $8.20. For Vistra, analyst consensus has historically been more optimistic than actual and have missed their target. Management guidance has been close in range, but actuals have also missed the target in previous years except for FY22. For example, in FY23, the net income guidance was between $1.86 and $1.96 billion, and analyst consensus was $1.57 billion. But analyst consensus missed the mark by 5% over, and management's guidance was over by 25%. But in FY24, management has been improving their communication by providing updated, narrower range closer to earnings announcements, so we are expecting the earnings surprise to be closer in range to the actual. The PE ratio is expected to decline significantly from 30 times trailing 12 months to the 2-year forward PE of 19 by 2026. This huge decline suggests earnings growth is expected to improve over time, making the stock relatively cheaper in future years. Comparatively, Constellation's trailing PE is valued higher at 34 times now, and the 2-year forward PE is 29 times. During this analysis, Vistra has clearly stood out as a financially stronger company than Constellation Energy. Similarly, their EV to EBITDA multiple is expected to decline over time from the trailing 15 times in 2024 to a forward EBITDA multiple of 11.6 by 2026. Improved EBITDA signals their operations are more streamlined and they're able to improve their margins, or that they're paying down debt and reducing their enterprise value. Whichever the reason, a declining EBITDA multiple may indicate that the company's becoming financially healthier and the future health is not reflected in the current valuation yet, which presents an opportunity. Average free cash flow yield is 1.7% for Vistra, whereas Constellation is negative 8.7%. The majority of the free cash flow for Vistra comes from their robust operating cash flow of $3.2 billion over the past 12 months, which demonstrates strong operational performance. The substantial cash that was used in investing activities over the last 12 months was related to the company's strategic investments, like the Energy Harbor acquisition. Vistra's free cash flow yield in FY24 is forecasted at 4.3%, and thanks to the Energy Harbor acquisition's cash flow addition, their 2-year forward free cash flow yield is forecasted to over 7%. The company did acquire debt as a result of the acquisition, but even with debt payments, their free cash flow looks strong over the next 2 years. And overall, Vistra has a strong cash position. In addition to the $905 million of cash, they can draw down from a $3 billion revolving credit facility, so they have $4 billion of available liquidity. As of Q3 2024, their net debt to adjusted EBITDA leverage ratio is 2.7 times, which is a reasonable ratio that shows that the company is careful at managing their debt. And their leverage ratio is the lowest that it's been in the last 10 years. Major spending plans for Vistra is related to their CapEx, in which they plan to continue to invest in maintenance and development of solar and nuclear energy facilities, and battery storage of about $1 to $1.1 billion per year. Their current cash position and their manageable leverage ratio supports their planned CapEx spending. For an energy company, they've shown strong dividend yield with a 5-year average of 2.6% versus an average of 0.9% for Constellation. Vistra's average yield of 2.6% is lower than some traditional utility companies like Duke Energy and Southern Company, which offers typically 3.5 to 5%, but it wouldn't be fair to compare Vistra to a traditional utility company, since they're valued in the market as a growth stock. But compared to other clean energy-focused firms like NextEra Energy, which has a dividend yield of 2.4%, and they don't have any nuclear in their portfolio, and Constellation's 0.9% yield, Vistra's 2.6% yield is reasonably high. Vistra has also been increasing its dividends, showing a commitment to return its capital to the shareholders. And with a payout ratio that's relatively low of 30 to 40%, Vistra is retaining earnings for reinvestment while still paying a stable dividend. Increasing free cash flow yield also shows that they'll continue to have the ability to sustain the same level or increase their dividends in future years. This is an attractive quality of Vistra as a long-term investor holding the stock until its eventual growth trend along with the energy boom in the US. You can also earn dividends simultaneously. Major growth potential is in store for Vistra, with mega-cap companies planning to invest in Texas over the coming years. For example, Google plans to invest over $1 billion in Texas to expand its data center infrastructure, and Toyota is investing over $500 million to expand its manufacturing facility in San Antonio, Texas. This is likely to create significant opportunities for Vistra through increased energy demand, potential partnerships in renewable energy, and long-term contracts to store energy, which is going to become even more in demand to ensure grid stability when they're powering data centers. The median analyst consensus target price is $185. This does not reflect the recent Moss Landing energy facility fire in Central California, which occurred on January 16th. But the impact to EBITDA is marginal at about $50 million annual loss, but analysts expect a couple of years until the facility is restarted. So overall, this may impact more than $150 million of EBITDA to the company. Based on this loss alone, the adjusted target price would be around $182. The company still presents a strong energy investment opportunity despite the losses. Not only is it in the right trend with energy needs, the company's management has shown remarkable strength in managing their debt, increasing the operational cash flow, and strategically aligning with the market direction for massive amount of clean energy needs by acquiring and expanding their nuclear portfolio. I am excited for Vistra's FY24 earnings, which will be released on February 27th.